quantum computing could become the next massive technological revolution, similar to how artificial intelligence exploded over the last few years. Many people wish they had invested in AI companies or semiconductor stocks before the boom happened, and now some investors believe quantum computing may offer a similar opportunity. The challenge, however, is that nobody truly knows which individual company will dominate the industry in the long term. Because of that uncertainty, many investors prefer the ETF approach, where instead of trying to pick a single winner, they buy a collection of the major companies involved in the sector. It's similar to what happened with semiconductor ETFs years ago. Investors who simply bought a broad semiconductor ETF rather than trying to choose the perfect stock still experienced enormous gains over time. The same strategy could potentially work with quantum computing as the technology develops. Quantum computing matters because traditional computers eventually reach limitations when solving extremely complicated problems. Classical computers operate using bits, which can only exist as either a 0 or a 1. Every digital activity we use today, from emails to streaming videos to video games, ultimately relies on huge sequences of those binary values. Quantum computers, however, use qubits, which behave very differently due to principles from quantum mechanics like superposition and entanglement. A qubit can exist in multiple states simultaneously, rather than only being a 0 or 1. That capability allows quantum systems to process vast numbers of possibilities at the same time, potentially solving certain problems dramatically faster than today's supercomputers. Some tasks are so mathematically complex that even the most advanced traditional computers would require billions of years to finish them. For example, optimizing delivery routes across thousands of cities and vehicles creates more possible combinations than there are atoms in the observable universe. Quantum computing could eventually transform industries that rely on solving these massive optimization problems, including logistics, financial modeling, air traffic management, pharmaceutical research, molecular simulations, and artificial intelligence training. Another major application involves cybersecurity and encryption. Current banking and internet security systems depend on the fact that classical computers struggle to factor enormous numbers into primes. A sufficiently powerful quantum computer could theoretically solve those calculations much faster, which is why companies and governments are already working on quantum-resistant encryption systems for the future. In many ways, quantum computing represents a bet on the next generation of computational power, especially as AI continues advancing rapidly and demanding greater processing capabilities. Of course, this sector also carries significant risk. Many quantum companies are still in early research stages, are not consistently profitable, and remain far from mass commercial adoption. Volatility is likely to remain extremely high for years. Still, supporters believe the same thing happened during the early stages of AI development, before adoption accelerated dramatically. One of the most recognized ETFs in the sector is the Defiance Quantum ETF, ticker QTUM. This fund is one of the oldest and most established quantum-related ETFs available. It follows an index focused on quantum computing and machine learning companies, but it also includes firms that manufacture supporting technology like advanced chips, semiconductors, and cooling systems necessary for quantum infrastructure. Over the years, the ETF has delivered strong average returns, and its expense ratio remains relatively competitive for a specialized thematic fund. Holdings include major technology companies such as Intel, Micron, and AMD, along with smaller pure-play quantum companies like IonQ and D-Wave. One advantage of the fund is its modified equal weighting approach, which prevents giant corporations from completely overshadowing smaller, high-growth quantum companies. However, some investors criticize QTUM because many of its largest holdings are not pure quantum computing companies at all. Much of the portfolio overlaps with broader technology ETFs that already contain large semiconductor and tech names. For investors wanting more concentrated exposure specifically to quantum computing, other ETFs may offer a more targeted strategy. One of the more aggressive options is the Wisdom Tree Quantum Computing Fund, ticker WQTM. This ETF focuses more heavily on pure-play quantum companies while still maintaining exposure to larger global technology firms involved in the space. The fund was developed with assistance from a quantum software company and aims to provide stronger exposure to the companies directly building quantum systems and infrastructure. Its holdings include companies like IonQ, Rigetti, and D-Wave, which together represent a large percentage of the portfolio. Because the top holdings account for such a substantial portion of the fund, WQTM tends to move more aggressively whenever quantum stocks rally. Unlike broader tech ETFs, it has minimal overlap with common growth funds such as QQQ or VGT, making it more attractive for investors specifically seeking dedicated quantum exposure. The main drawback is that the ETF itself is still very new, meaning investors have limited historical performance data to evaluate. Still, for people willing to accept higher risk in exchange for greater potential upside, WQTM stands out as one of the more focused quantum investment vehicles currently available. International investors also have access to several strong UCITS quantum ETFs, including options from iShares and VanEck. These funds provide much heavier allocations to actual quantum computing companies compared to many US-based alternatives. Their holdings prominently feature companies like IonQ, D-Wave, Rigetti, IBM, and Intel. However, because these are European-domiciled UCITS ETFs, US, investors may face brokerage access limitations and potential tax complications when attempting to purchase them. Brokerages such as Interactive Brokers and Saxo Bank may provide access, but these products are generally more practical for investors located outside the United States. Another interesting option combines both AI and quantum exposure, the iShares Future AI and Tech ETF, ticker ARTI. This ETF has experienced enormous growth recently, largely due to the strength of artificial intelligence stocks. While it is not purely a quantum computing ETF, it still maintains positions in dedicated quantum companies alongside major technology firms leading both AI and quantum research. Holdings include IBM, Microsoft, Nvidia, Google, IonQ, D-Wave, and Rigetti, as well as companies producing specialized equipment needed for advanced computing labs. Compared to concentrated quantum funds, ARTI leans more heavily toward AI infrastructure and established technology leaders, making it somewhat less risky while still providing meaningful exposure to quantum development. A similar approach can be found in the WisdomTree AI and Innovation Fund, ticker WTAI. This ETF primarily focuses on the broader AI ecosystem but includes quantum computing as part of the future innovation landscape. It invests heavily in semiconductor manufacturers and memory companies such as Micron, Samsung, and SK Hynix, along with major tech giants like Amazon and Google. Because of its broader diversification, WTAI may not fully capture the explosive upside of a pure quantum breakout, but it could offer a smoother ride with lower volatility. Finally, there is the Roundhill Memory ETF, ticker DRAM, which takes a completely different approach. Rather than focusing directly on quantum companies, it targets memory and storage manufacturers that provide the critical infrastructure supporting AI and advanced computing systems. This ETF concentrates on producers of DRAM and NAND memory technology, which are essential for high-speed data processing in AI servers and data centers. Unlike broader semiconductor ETFs, it excludes companies like Nvidia and AMD to focus specifically on memory hardware manufacturers such as Micron, Samsung, and SK Hynix. For investors already heavily invested in AI semiconductors, DRAM could complement existing holdings by providing exposure to another essential layer of computing infrastructure. Overall, investors interested in quantum computing face a choice between concentrated, high-risk pure-play funds and broader ETFs that combine quantum exposure with AI and semiconductor infrastructure. Pure quantum funds may offer greater upside if the technology evolves into what many expect, but they also carry much higher uncertainty. Broader AI and technology ETFs provide more stability while still allowing investors to participate in the long-term growth of quantum computing as the industry matures.